Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings. Today we're diving into Kingsway Financial Services' latest 10K. It's a bit of a mixed bag. Think surprise birthday party where half the guests didn't show up. There's some good news, some not so good news, and a whole lot of financial maneuvering. Let's get started. First off, Kingsway Financial Services is a holding company, which basically means they own other companies. These subsidiaries operate mainly in the extended warranty and business services industries. So picture them as a diversified investment firm with fingers in a few different pies. They have two main segments, extended warranty and Kingsway Search Accelerator. Let's talk about some of their big moves. In September of last year, they bought Image Solutions, an IT managed services provider, for about $24 million. This falls under their Kingsway Search Accelerator segment, which they also refer to as their CEO Accelerator program. At the same time, they sold VA Lafayette, a real estate property, to someone already holding some of their preferred stock, netting a cool $1.1 million after expenses. Then they did a private placement selling a new series of Class B preferred stock for $8.3 million. This Class B preferred stock ranks higher than the common shares, so those investors get first dibs on dividends and assets. So in short, this means Kingsway got an injection of cash, shuffled some assets, and brought in some new shareholders with special privileges. Now let's move on to some numbers to see how the company performed financially in the recent year. For the year, the extended warranty segment, which includes those vehicle service agreements we talked about, had revenues of about $68.9 million, while the Kingsway Search Accelerator pulled in around $40.5 million. Operating income for the extended warranty segment was around $5.9 million. The Kingsway Search Accelerator pulled in around $40.5 million. Operating income for the extended warranty segment was around $5.9 million of about 60-day warning liners. Operating income for the extended warranty segment was around $5.9 million. The Kingsway Search Accelerator pulled in around $40.5 million liners. Operating income for the extended warranty segment was around $5.9 million. The Kingsway Search Accelerator pulled in around $45 million. Operating to $1 million for the extended warranty segment was around $5.9 million. Overall, looking at the total operating income, we can see a consolidated figure for the year of $11.6 million, down from $12.2 million the previous year. Then we see that net investment income also dipped from $1.6 million to $1.4 million to $1.4 million to $1.4 million. Canadian dollars to have net realized gains up from $761,000 to almost $1.6 million. However, that's where the good news starts to fade. There was a huge $3.4 million loss on equity investments compared to gains in the prior year. Turns out one of their previous big wins in 2023, when they sold all their shares in Limback Holdings, didn't repeat itself. After all is said and done, the operating loss for the year, after debt amortization and goodwill, is down Sav 8 on 4 wings, didn't repeat itself. After all is said and done, the operating loss for the year, after debt amortization and goodwill, is down Sav 8 I 21 million. A far cry from the $25.06 except after all is said and done, the operating loss for the year, after debt amortization and goodwill, is down after all is said and done, the operating loss for the year, after debt amortization and goodwill, is down Sav 80 turned million. A far cry from the 25 to 6 million goodwill, is down Sav at all is said and done, the operating loss for the year, after debt amortization and goodwill, is down Sav 80 turned the operating. Speaking of losses, it looks like their reach for growth didn't go too well this year, so let's take a look at the goodwill table. This is where things get interesting. They had to record a whopping $2 million in impairment charges, mostly impacting SNS, Sequite, and Ravix. These are write-downs. The reduction in value is primarily due to higher discount rates, and a reduction in value is primarily due to higher discount rates, and a reduction in value is primarily due to higher discount rates, and a reduction in projected revenue for those businesses. What this all means is Kingsway had to admit that these acquisitions weren't as valuable as they hoped for. So while they acquired assets, turns out those assets weren't great at making money. Now let's talk debt. They have a lot of it. As of the end of the year, they had about $59.6 million debt outstanding. This includes both their old trust preferred securities and new loans they took out to fund their acquisitions. About $775 million, doing that great by itself to begin with. Here's where it gets complex and worth paying attention. Tax benefits. Kingsway has a huge amount of net operating losses, or NOLs, like $622.3 million worth. Think of NOLs as coupons for future tax bills. They can use these to reduce their tax payments in the future, but the problem is that if they have an ownership change, as defined by tax law, their ability to use these NOLs will be seriously limited. In short, if too many new people buy too much stock, it could trigger a tax event and severely limit the value of those tax breaks. Also, since they're no longer considered a smaller reporting company, they will need to have the auditor attest to their internal financial controls. Shifting gears, it is worth pointing out they talk about cybersecurity risk. Companies now have to say how they oversee these risks. Kingsway notes that their board's audit committee is in charge, and they are taking steps to educate employees and maintain backups. However, they also state that the company doesn't think a cyber attack is reasonably likely to materially affect Kingsway, which might be a bit optimistic to say out loud. Finally, it is worth pointing out a warning about the extended warranty subsidiaries. They sell vehicle service agreements, and it's difficult to perfectly forecast the expenses for policy administration and claim handling services. The company warns if we amortize the deferred service fees too quickly, we could overstate current revenues, which may result in a future significant reversal of revenue and adversely affect future reported operating results. In terms of trends, Kingsway Search Accelerator's success is based on venture-funded startups. If the venture capital funds slow down their funding for whatever reason, economic conditions, world events, this would significantly harm Revix's earnings. Side now, let's zoom out and take a look at the big picture. So Kingsway is at a crossroads. They're trying to transform themselves from a holding company filled with insurance businesses that are underperforming to a dynamic portfolio of diverse tech-enabled businesses. And here's my take. Things they're doing right. They're definitely making moves. The acquisition strategy is interesting, particularly with the CEO Accelerator program. That brings in businesses and talented management. And on top of it, they recognize all of this and have a detailed risk section where they could improve. Debt, debt, debt. All that debt is like carrying a piano on your back during a marathon. The high amount of debt is very risky since the rising interest rates are eating away the company's potential income. Bottom line, Kingsway is a company with potential hampered by debt and some questionable bets, so their future depends on successful integration and smart capital allocation. Thanks for watching, and make sure you subscribe, like and comment if this has been insightful.